In September 2001, one day before the world changed forever, two men launched a small investment fund from a modest office above a shop in West London, opposite a Chinese restaurant. They had no Bloomberg terminals plastered across the walls, no army of analysts, no proprietary algorithms. What they had was a single whiteboard on which they had written the very few investment models they believed actually worked. Over the next 13 years, their fund, the Nomad Investment Partnership, returned 921% net of fees to investors, compared to just 117% for the MSCI World Index over the same period. To put that plainly, $1 in the index became roughly $2. $1 with Nomad became over 10. They didn't trade frequently, they didn't short stocks, they didn't use leverage, and when it was all over, they didn't launch a bigger fund or go on TV. They simply handed back the money, told their investors exactly what to do with it, and walked away. Their names are Nick Sleep and Qais Zakaria, and this is the story of what they found written on that whiteboard. To understand what made Nomad so unusual, you first need to understand the man who created it. Nick Sleep studied geography at the University of Oxford. Not finance, not economics, geography. He would later describe this as a feature, not a bug. Geography, he said, is a subject with an identity crisis. It pulls from geology, physics, chemistry, oceanography, climatology, biology, sociology, psychology, statistics, and economics. It is, in his words, the ultimate polymath course. This multidisciplinary instinct, the habit of asking, how does this actually work, rather than, what does the model say, would define everything Nomad did. Sleep joined Marathon Asset Management in London in 1995, and it was there, in the late 1990s, that he met Qais Zakaria, a sell-side analyst at Deutsche Bank specializing in Asian equities. Both were independently seeking investment opportunities in Asian markets. Zakaria eventually left Deutsche Bank to join Marathon, and the two began developing a shared philosophy. Then, on September 10, 2001, one day before 9/11, they launched the Nomad Investment Partnership, initially as a subsidiary of Marathon. By 2006, they spun out to operate independently. From the very beginning, they did things differently. Their letters were typed in courier font. They rarely communicated with investors. They had no pitch decks. Instead, they quietly studied businesses like anthropologists, and they were radically honest about something most fund managers would never admit. Their goal was not to maximize assets under management, it was to maximize returns for the people who trusted them. Their fee structure reflected this. The management fee was designed as a break-even cost reimbursement, not a profit center. It was capped and declined as the fund grew. The performance fee was charged only on returns above a 6% annual hurdle rate, and crucially, it was deferred and refundable, held in reserve for 5 years, at risk if performance deteriorated. This was not how the industry worked, and that was precisely the point. Now we get to the whiteboard. Most investors, when they find a company with scale advantages, ask the same question. How much of that advantage can we capture as profit? They want fatter margins, higher returns on equity, expanding multiples. Nick Sleep asked a completely different question. What if the most powerful thing a company could do with its scale advantage was give it away? He called this concept scale economies shared. Most companies pursue scale efficiencies, but few share them. And it's the sharing, he argued, that makes the model so powerful. The company grows through giving back. Here is how it works. As a business grows larger, its costs per unit fall. A traditional company pockets that difference as margin. A scale economies shared business does something counterintuitive. It passes that saving directly to the customer in the form of lower prices. Lower prices drive more purchases. More purchases drive greater volume. Greater volume drives even lower costs. And the cycle reinforces itself indefinitely. Sleep measured this with what he called a robustness ratio, how economic benefits were divided between customers and shareholders. Now, Here's where this gets remarkable. Sleep didn't just discover this framework by accident. He found it written in a memo from 1967. A memo written by a man who had never heard of Amazon. And when Sleep showed this memo to Costco's founder, Jim Sinegal, decades later, Sinegal stopped mid-sentence and said, "I must show you this." What Sinegal showed him next explains exactly why Costco is almost impossible to compete against. That's in 2 minutes. The clearest example in Nomad's portfolio was Costco. The consensus on Costco in the early 2000s was that it was a low-margin retailer with an expensive stock and a cost problem. Sleep's conclusion in 2004 was almost the opposite. He described it as a cost-disciplined, intellectually honest, high product integrity, perpetual motion machine trading at a discount to value. And then there was Amazon. While most investors in the early 2000s viewed Amazon as an unprofitable retailer sacrificing margins for growth, Sleep interpreted the strategy very differently. He saw a company deliberately building a system designed to compound through scale. Jeff Bezos often summarized this philosophy simply: "Your margin is my opportunity." In 2007, Sleep noted that his scale economics shared model applied to internet retailers who were in an early growth stage and could achieve a vast competitive advantage by opting to use their benefits of scale to reduce prices. Unlike Costco, internet retailers could rapidly add scale with near-zero incremental capital. He was describing Amazon roughly a decade before the rest of the market figured it out. But identifying great businesses is only half the equation. The harder part is holding them long enough for the compounding to work. Sleep called his approach destination-oriented investing. He observed that most investors fixate on the short-term volatility of a stock's price, trying to make the journey as smooth as possible. This, he argued, was a costly mistake. Traveling comfortably dominates people's thinking when they should be thinking about destinations. Think about what this means in practice. When you buy a stock, you are making a prediction about a destination, where this business will be in 10 or 20 years. The daily price movements, the quarterly earnings misses, the analyst downgrades, these are turbulence on the flight, not information about where the plane is going. Sleep wrote in 2005, "Annual results will bounce around all over the place, and for Nomad, more so than more diversified funds. But does that matter if the destination is secure?" This philosophy had a direct consequence for how Nomad was structured. Sleep and Zakaria concentrated on the price-to-value ratio of the partnership and explicitly told investors to ignore its performance as much as possible. Substack. They were asking their partners to judge them not on how they were doing this year, but on whether they were heading somewhere worth going. In Nomad's early years, the fund held almost half its assets in typical value plays, discounted asset-based businesses, the cigar butts that characterize Graham's investing style. But Sleep could see that Nomad's destination was in owning honestly run compounding machines. As early as 2004, he set out what he called the terminal portfolio, where he wanted to eventually be. By the end of the partnership, that terminal portfolio had arrived. 3 companies: Amazon, Costco, Berkshire Hathaway. That was essentially the whole fund. Charlie Munger once said, "Take a simple idea and take it seriously." Sleep found his simple idea, and he took it about as seriously as anyone ever has. In 2014, with the fund at the height of its powers, Sleep and Zakaria did something almost no fund manager has ever done. They closed it. Rather than compromise their philosophy to satisfy compliance requirements, adding positions they did not believe in, trading when they saw no reason to trade, they returned every dollar to their investors. And then they told their investors exactly what to do with the money. In Sleep's words, "Zach and I are keen to leave the professional industry behind and spend our time in more caring pursuits." Their parting advice was as simple as everything else they had ever done. Buy Amazon, Berkshire Hathaway, and Costco. Own them in your personal account, and do not touch them. There was no pitch for a successor fund, no reinvention, no fee structure to protect, just, "Here is what we believe, here is what we own personally, and here is our parting advice." Sleep remains invested in Amazon and Costco to this day. In a 2021 preamble written for the collected letters, Sleep noted that the annual performance of Nomad had stood at around 20% for 20 years, and offered this reflection. Evidence, perhaps, that investors don't have to go changing their holdings with their underwear. The letters themselves, over 110,000 words of the sharpest writing on long-term investing ever produced, are now available in print through the IGY Foundation, Sleep's charitable organization. Monish Pabrai has called them the Dead Sea Scrolls of investing. So what is the lesson of Nomad? It is not simply that patience pays off, though it does. It is not simply that concentrated portfolios outperform diversified ones, though they can. The real lesson is more specific and more actionable. There is a category of business, rare but identifiable, that compounds by design. Not because it gets lucky, not because a visionary CEO one day decides to be generous, but because its entire economic structure rewards giving back to customers more than it rewards taking from them. These businesses attract more customers, which generates more scale, which funds more giving back, which attracts more customers. The loop is self-reinforcing and, if you find one early enough, almost inescapable. Nick Sleep found the framework for identifying these businesses on a whiteboard above a shop in West London. He spent 13 years testing it, and then he walked away with the quiet confidence of someone who had found something true and followed it to its conclusion. The Nomad letters are available free on the IGY Foundation website. If you haven't read them, I would start this weekend. And if you want the 5 best book summaries that pair with this philosophy, Richer, Wiser, Happier covers sleep directly, and The Intelligent Investor, Poor Charlie's Almanac, 100 Baggers, and The Outsiders all fill in the surrounding framework. Those are all on this channel.